Good morning, teachers. Today we're taking a look at something that I had gotten a couple of requests to make a video on, and that's going to be the balance of payments, or what we call BOP accounts. So this is the very last unit of the AP Macro course. This, along with foreign exchange market, are basically the last things we do. And so if you've gotten to this point, congratulations, you are almost there. So what we're doing with balance of payments requires the kids to call upon a lot of their knowledge from the banking sector, because essentially doing the BOP account, or the balance of payments, is very similar to running banking balance sheets, or those T-charts that they learned about, where you put assets on one side and liabilities on the other. So essentially what a BOP account is it's tracking a nation's credits and debits to a couple of different accounts. So it's going to track trade and kind of the exchange of goods and services in the current account, and it's going to track the flow of money back and forth in the financial account. And this is something that's important because current account balances, financial account balances, are going to affect all sorts of things that are relevant to the macroeconomy, most notably aggregate demand, and they are affected by lots of things that we do, such as monetary policy. So there's quite a bit going on here that the kids are going to want to track. It's not a particularly difficult thing if they know how to do T-charts from the banking sector. This is just like a slightly more complicated version of that. But we're going to run through that today, and we're going to kind of do some basics of just the things the kids absolutely need to know, because we are running a little short on time. We want to make sure that we can get them all the information they need to know for the AP exam. So once again, there are two counts in the balance of payments. One is called the current account, and one is called the financial account. Let's go into what goes into each one. So taking a look at the current account, what we're basically trying to do here is we're making an additional T-chart within the current account, where we're going to track the credits to the economy. In the case of the current account, those credits are in the form of our nation's exports. And we're going to track the debits from our economy, which for the current account are going to be our nation's imports. So any imports that come into the country are going to go into the debits column and basically be a negative number. And any exports that we send to other countries are going to be a positive number. We're going to sum those things out when we're done. So there's essentially four different classes of things that go into the current account. The main gist of the current account is that for the most part, it is tracking the flow of goods and services. It's tracking stuff as it goes in and out of our economy. So the main things that you're going to see show up on the AP exam for your current account are going to be goods, which are what we generally think of as imports and exports. So we export a lot of, heavy machinery. We export agricultural goods. We import, lots of small manufactured goods. We import, or at least up to recently, imported a lot of oil, those types of things. So the kids don't really have a difficulty with the tangible products. They can tell you roughly what it is our country makes and what it is our country buys, because certainly, especially for the imports, they're consumers of a good chunk of foreign goods. The part that it becomes a little bit harder for the kids to understand is when we get to services, because the services are intangible. So the main services you'll see show up under imports and exports are things like shipping. So for example, if a United States company is shipping a set of BMWs from Germany to the United States, it's actually a product the United States is producing. That shipping is a service, even though it's an intangible service. And so the shipping that we provide to the Germans to bring their BMWs here would count as a U.S. export, because it's a service produced by the United States and sold to a foreign power. So for these, you'll see things like shipping, you'll see transportation, you'll see financial services. The United States is a big provider of financial services, and so forth and so on. So you may want to just get it to the kids that it's not just tangible goods, it's not just stuff that shows up on ships that counts to the current account, but services we provide, banking and those types of things also show up. Much less commonly, you'll also very rarely see factor income and transfers show up in the current account on the AP exam. Basically, what they need to know about this is it's generally remittances and foreign aid that show up here as factor income and transfers. So the kids do need to know what remittances are. That's when money is earned in one country but sent home to another. A lot of them are familiar with like Mexican immigrants here earning money in the United States and then sending some of that money back home. That's what's called a remittance, and that shows up in the current account, as do net transfer payments, things like foreign aid, and so forth and so on. Usually we generally talk about the United States as a net exporter of foreign aid, but occasionally, as was the case with Harvey, we do import a little bit of foreign aid as well whenever we have a disaster. The end result of all of this, if you add up all the imports and you add up all the exports and you add them together, if you end up with more imports than you have exports, we say this is a current account deficit. Colloquially, they'll call this a trade deficit. Technically speaking, a trade deficit and a current account deficit are a little bit different, but for the purposes of this test, it doesn't make a huge difference to the kids. And if exports are greater than imports, we have a current account surplus. And apologies, I forgot to add the S to surplus there. There we go. So current accounting, basically tracking the imports and exports of goods, services, factor income, and transfers. And we're trying to figure out if we end up with a negative number at the end of this, we're going to have a current account deficit. And if we end up with a positive number at the end of this, there's going to be a current account surplus. Moving along to the other side, we have the financial account. The financial account is primarily responsible for tracking the flow of money that goes in and out of an economy. So on your left-hand side, we're going to track capital outflows. So a capital outflow is any time money comes from your country and goes and is invested in a foreign country. So for example, if Coca-Cola decides to build a factory in China, they're taking U.S. profits because Coca-Cola is an American company. They're investing them overseas, and that's going to be a net capital outflow. And those net capital outflows are going to be debits to the financial account. So basically, we count these as a negative to the economy, because that's money that could have been invested here, but it's being invested overseas instead. It's creating jobs and it's creating growth, but it's creating jobs and growth overseas. So anytime U.S. investors are putting money overseas, that's a net capital outflow. And vice versa, if foreign investors are putting money into the United States, that's going to count as a net capital inflow. We count these inflows as a credit to this account because it adds to our market for loanable funds, lowering interest rates and increasing investment in the United States, which we generally see as a good thing. Really, what shows up on the financial account is a lot simpler than what shows up in the current account. There's really only two things that you'll see show up as inflows and outflows, and those are going to be investment in physical capital or assets. So this might be Americans that are investing in, physical capital and assets overseas. So they're buying up a foreign company, or they're buying foreign real estate, or they're building physical capital. They're building factories overseas, and those things are going to show up as outflows. Inflows is when foreigners, what we usually call net foreign investment, when people from overseas invest their money here. So they're going to build a Toyota factory in San Antonio, Texas. That was a capital inflow. Or they're going to buy a company. So for example, a few years back, a Chinese company purchased Smithfield Ham. That was a huge multi-billion-dollar capital inflow because it's foreign money that shows up in the United States and is being used to buy our physical capital and buy our assets. The other side of this is going to be investment in financial assets and financial capital. This is one kids have a little bit harder time with. So when we go to other banking systems, a lot of times what we'll see, and we're going to get to this when we get to the foreign exchange market, is that dollars will chase a higher interest rate, right? So savings wants to earn a higher interest rate, not a lower interest rate, and that's one of the main sources of capital inflows and outflows. When our country has a higher interest rate than others, then foreign money flows here. If some other country is offering a better interest rate, our money might flow there. So when we talk about financial assets, we're talking about the flow of savings in and out of an economy. We're talking about the purchase of foreign assets like stocks, not physical assets, but financial assets, and the purchase of foreign bonds and other purely financial transactions. So you could tell them that when the United States sells bonds to foreign governments to fund our national debt, that creates a net capital inflow because it's foreign money showing up here, being lent to our government, and being spent here in the United States. Those are really the only two things that kids will see show up in this account, and they'll both show up on both sides. So you're going to have capital outflows of U.S. investment happening overseas and U.S. savers, lending money to foreign governments, and vice versa as well. Very similar to the way the current account works, if outflows exceed inflows, we say this is a financial account deficit, and if inflows exceed outflows, we say that we had a financial account surplus. Now, for the most important thing of the entire lesson, and this is the thing that kids really, really need to be able to do. When we do balance of payments in the AP Macro course, we are going to pretend, even though that's not how it really works in reality, in economics land where we exist in this course, we are going to pretend that the current account and the financial account always balance, meaning that the sum of your current account plus the sum of your financial account for the purposes of this test will always equal 0. That means it's very, very simple to do balance of payments for the AP exam because I only have to know the balance of one half and I automatically know the balance of the other. So essentially, you're always going to have a surplus on one side of the account and a deficit on the other, and the deficit is always going to be equal to the size of the surplus. So if the United States is currently running an $800 billion current account deficit because our imports exceed our exports, we can expect to be running an $800 billion financial account surplus as the inflows will exceed our outflows. And the reason for this is because when we run a current account deficit, basically we're giving people in foreign nations more money than they're giving back to use to purchase our exports. So essentially more of our money is leaving the country than is coming back in. But those U.S. dollars that we use to pay for those imports are going to come back into the economy eventually. And if they're not buying our exports, they're going to come back into the economy in the form of net foreign investment. So we're going to see people purchasing our financial assets with the money they've earned by selling us their exports, which become our imports. So I usually have the kids watch a very short video on YouTube to kind of get this across, because I think that it's a lot easier to see it happen than it is for me to try to explain it. So if you look up the video on YouTube, Squanderville versus Thriftville, it's about a 3-minute video. It features Warren Buffett telling a little bit of a story. It's from a much larger IOUSA that I'm not a huge fan of, but this particular piece I think is really helpful in explaining why the current account and the financial account will eventually balance. So I highly, highly recommend spend 3 minutes in class, 4 minutes in class showing the kids that video. I think it does a better job explaining it than I can ever do. Hopefully the balance of payments isn't quite as scary as it may have initially seemed. Basically, we're just making T-charts. In this case, it's a T-chart made of 2 different T-charts, but nothing that goes in it is particularly complicated. The kids have a pretty good grasp of what imports and exports are. They won't really understand capital inflows and outflows. That's going to require a little bit more explanation. But I think that even the names themselves make it fairly obvious what's going on. So with a little bit of explanation and a little bit of practice, students can do this as well. Thank you very much, and let me know if you've got any questions. You know where to reach me.